It's a great pleasure to have the opportunity to speak here today at the Japan Society. Japan and the U.S. have very close relations, and I can assure you this is especially true at the central bank level. I just got back from the Bank for International Settlements last week, and I had a chance to spend some time with Governor Kuroda. He's off to a very strong start, I might add. Today I'll discuss the challenges that we've both been working to solve, how best to conduct monetary policy when short-term rates are already pinned close to zero, but the economy is still operating well below its potential. This has required considerable learning for both of us. After all, until Japan's experience began in the 1990s, no major country had actually faced this problem since the Great Depression of the 1930s. As the first nation to experience the zero bound in modern times, Japan was an early pioneer in developing unconventional tools and strategies. Its experiences, both good and bad, along with the lessons of other periods such as the Great Depression, have helped to inform the policies adopted by the United States and other nations in recent years. The evolution of policy in Japan, in turn, has been informed in part by our experience and the experience of other nations. So what have we learned to date? Well, let me highlight 6 key points. First, and most importantly, managing expectations is critical in the execution of monetary policy at the zero bound. This includes expectations about the central bank's objectives for inflation and the economy, and expectations about how the central bank will use its tools in the future to achieve these goals. Second, in managing expectations, good communication is essential. Expectations will not be well anchored when communications are muddled or inconsistent, or when a central bank acts in ways that are not consistent with its guidance. Third, actions speak louder than words alone. Thus, there is an important role for asset purchases that ease financial conditions to support growth and keep inflation expectations well anchored. Fourth, the policy instruments interact so that the policy as a whole exceeds the sum of its parts. Fifth, at the zero lower bound, risk management becomes extremely important. In particular, because the cost of getting stuck in a liquidity trap with chronic deflation are so high, a central bank needs to put substantial weight on avoiding such an outcome. And 6, the constraints imposed by the zero bound limit what monetary policy can accomplish by itself. This increases the importance of complementary policies in the fiscal, financial, and structural realm. Credible fiscal policies, actions to ensure a healthy financial system, and structural reforms that lift the potential for growth are all very important. As always, what I have to say today represents my own views and not necessarily those of the Federal Open Market Committee or the Federal Reserve System. So let me start by briefly reviewing the experience of Japan and the United States. As you all know, Japan's rapid economic ascent and investment boom came to an abrupt halt in the early 1990s with the bursting of a gigantic bubble in equities and real estate. Asset price deflation resulted in a huge decline in wealth. This led to a sharp fall in demand, a balance sheet squeeze for both businesses and households, and a large increase in problem loans for the Japanese financial institutions. By some measures, such as the loss of wealth relative to the size of the economy, this was a bigger shock than the U.S. experienced in 2008 and 2009. Growth slowed sharply and inflation fell. The Bank of Japan responded by reducing overnight interest rates from a peak of more than 8% in early 1991 to 0.5% by the fall of 1995. Most studies of this period suggest that policy was generally appropriate given economic forecasts at the time, but too tight relative to actual outcomes. Economic forecasts for Japan, both by the official community and by private sector agents, were consistently more optimistic than the actual outturns. It's noteworthy to me that as late as January 1995, on the eve of deflation, 10-year JGB yields were still at 4.7%. With the benefit of hindsight, we now understand that the disinflationary consequences of the asset price bust and financial stress were vastly more powerful than was widely realized at the time. As we later saw in the United States, the forces of contraction and deflation operated through many different channels, not just directly on household wealth, for example, but also through the impact of the asset price bust on the health of financial intermediaries and the supply of credit to households and businesses. Over time, the Japanese banking system came under mounting stress. This was a slow-motion crisis, as the assets were mainly loans that were not marked to market. Accounting practices and regulatory forbearance allowed banks to delay charging off bad loans and recapitalizing, but this came at the cost of impairing the availability of credit to new potential borrowers. Finally, a full-blown banking crisis materialized in 1997. And although some banks were recapitalized in 1999, the full regulatory response took several more years to be completed. The monetary and fiscal stimulus that was provided helped Japan avoid a deep recession. But expectations about future nominal income growth for both households and businesses ground lower over time. With inflation expectations sinking, inflation-adjusted real interest rates rose, and soon Japan became mired in deflation. Now, while it's true that deflation is ultimately a monetary phenomenon, structural elements in the case of Japan were also important. Long-term demographic factors added to the deflationary pressures, and structural rigidities and credit supply problems constrained the ability to reallocate resources to sectors that were more inclined to grow more rapidly. These structural factors made it substantially more difficult to escape from the deflation trap. Now, the Bank of Japan was quite active during this period. From the late 1990s onward, it pioneered an extremely broad array of innovative tools, many of which were later adopted and amended for by the Federal Reserve and by other central banks around the world. These tools included forward guidance on the future path of the policy rate, quantitative easing through purchases of government securities and private assets, including asset-backed securities, equities, and real estate investment trust, a more quantitative inflation objective, and a funding for bank lending program. From my perspective, Japan's experience with forward guidance for the policy rate, asset purchases, and a more formal inflation goal are particularly instructive, as this has helped inform the later use of such tools in the United States. In early 1999, the Bank of Japan said it would maintain its zero interest rate policy until, quote, deflationary concerns, unquote, were quote, dispelled, unquote. This commitment was lifted in August 2000, and the Bank of Japan raised the policy rate by 1/4 point. However, the Bank of Japan was subsequently obliged to reverse course, and forward guidance was reintroduced in March 2001. This guidance was tied to the realization of a new inflation objective. With deflation continuing and intensifying, the Bank of Japan embarked on a quantitative easing program in 2001 designed to increase the size of the monetary base. The monetary base is the amount of currency and reserves in the banking system. The Bank of Japan engaged in purchases of Japanese government bonds, or JGBs, that were large in scale, but were confined mainly to short-dated maturities. This reflected a view that such purchases primarily acted through the liability side of the central bank's balance sheet by pushing up the amount of reserves in the banking system. Because the growth of the monetary base, currency plus reserves, was deemed to be the goal of policy, it was logical to purchase short-dated assets because these could be allowed to run off once a sustainable recovery was in place. It would be easy to normalize the Bank of Japan's balance sheet. The downside of this approach was that the purchases did not change the composition of the private sector's balance sheet very much, because the policy essentially resulted in the exchange of one short-term risk-free asset, short-dated JGBs, for another, bank reserves. As a consequence, the purchases had only modest direct effects on financial conditions. Starting in 2006, when the initial wave of quantitative easing ended, the Bank of Japan began to formalize its inflation goal in numerical terms. This was initially expressed as, quote, understanding of medium to long-term price stability based on individual policymaker views, unquote. The inflation objective went through several iterations before being defined in 2012 as a committee goal of a positive range of 2% or lower, with a lower interim goal of 1%. Following the onset of the global financial crisis in 2007 and 2008, Japan resumed QE and gradually tightened the link between its policy actions and its objectives. By January 2012, for example, the BOJ had committed to keep rates at the zero bound and to continue purchasing assets until the 1% inflation goal was in sight. Now, several prominent Japanese experts have argued that there was a stop-start aspect to monetary policy during the 1990s and 2000s, with the reversals in policy starting before deflation expectations were fully eliminated. Fiscal policy also reversed abruptly on several occasions before the economic recovery had been firmly established. While Japan did enjoy a period of respectable real per capita growth in the mid-2000s, escape from deflation proved elusive. Now, more than a decade after Japan's bubble burst, the U.S. housing had a similar collapse. This exposed extensive vulnerabilities in our financial system and triggered a global financial crisis. Unlike Japan, we did have the advantage of being able to learn from another nation's recent experience. We applied what we understood to be the lessons from Japan, though with hindsight, perhaps not in every respect as completely as we could have. In particular, Japan's experience reinforced the lessons of the Great Depression here in the United States and made us sensitive to the disinflationary force of an asset price bust and financial crisis. We recognized that we had to be very aggressive to prevent deflation and deflation expectations becoming firmly entrenched. As a result, the Federal Reserve reduced short-term interest rates to near zero by late 2008, a little over a year and a half after the initial shock hit in August 2007. Immediately upon reaching the zero bound for interest rates, we provided additional stimulus by expanding our balance sheet and deploying forward guidance with respect to the policy rate. These actions, in the context of a strong commitment to both our inflation and employment mandates, succeeded in preventing deflation expectations from taking hold, even though outcomes for the real economy were disappointing. We also took steps to formalize that we had a 2% inflation objective. The Fed's large-scale asset purchase programs differed from those originally undertaken in Japan, both in theory and in practice. Our purchases were concentrated in longer-term securities, treasuries, and agency mortgage-backed securities. This reflected a different perspective on how purchases affect financial conditions in the economy, as well as the different structure of the U.S. and Japanese financial systems. Our view is that asset purchases work primarily through the asset side of the central bank's balance sheet by transferring duration risk from the private sector to the central bank's balance sheet. This pushes down risk premia and interest rates and prompts private sector investors to move into riskier assets. As a result, financial conditions become easier, and this supports wealth and aggregate demand. Under our theory, the fact that such purchases increase the amount of reserves in the banking system and the size of the monetary base, that's a byproduct of our actions, but it's incidental. It's not a goal of our quantitative easing programs. The U.S. also moved relatively quickly to recapitalize our core financial institutions. Part of this was good judgment, but also part of it was the intense pressures that our capital markets-based financial system put on our financial system, which forced us to confront these issues. The Supervisory Capital Assessment Program, or SCAP, that we did in early 2009, identified and addressed the potential capital shortfalls of the major U.S. bank holding companies in a stress scenario. The SCAP forced the banks to recapitalize either by raising private funds or through the ejection of government convertible preferred equity from the TARP program. All that said, though, our policy approach was far from perfect. Comparing actual growth to the growth projections of the FOMC participants in the summary of economic projections that we do quarterly shows that we've been consistently too optimistic about growth over the 2009-2012 period. As a result, with the benefit of hindsight, we did not provide enough stimulus. Perhaps if we paid more attention to the persistent divergence between the growth forecast and actual outturns in Japan in the 1990s, we might have been more skeptical about the prospects for a strong economic recovery here in the US, even with a more aggressive monetary policy regime in place. Also, we could have done a better job in communicating our intentions and goals. In my opinion, we put too much emphasis too early on exit. At an earlier stage, we should have put more emphasis on our commitment to use all our tools to the fullest extent possible for as long as needed to achieve our dual mandate objectives. Our policies also had a start-stop aspect to them that may have undercut their effectiveness. For example, until September 2012, our large-scale asset purchase programs generally specified the total size of the program with a purchase rate and expected ending date. This created a void when the programs ended and made our policy response sporadic and hard to forecast. This limited the scope for market prices to adjust in anticipation of our future actions in ways that would have helped to stabilize the economy. Another shortcoming was in our use of forward guidance with respect to the path of short-term interest rates. Although our calendar date-based guidance worked reasonably well in influencing expectations about the future path of short-term rates, and thus the shape of the yield curve, it was clumsy in a number of respects. For example, if we move the forward date guidance out in time into the future, does this reflect a change in our reaction function? Does this reflect a change in the amount of desired policy stimulus? Or does this reflect greater pessimism about the outlook? It's unclear. Of course, as we have learned, we have acted to rectify some of these shortcomings. For example, our asset purchases are now outcome-based, tied to the goal of substantial improvement in the labor market outlook. And our forward guidance on short-term rates is tied to unemployment and inflation thresholds rather than to a particular calendar date. At the same time, the Japanese authorities have also capitalized on our joint experiences and actions. Thus, we've witnessed a convergence in the monetary policy regimes between the two countries. Today, the two regimes are quite similar in three important respects. Both the Fed and the Bank of Japan place considerable emphasis on an explicit inflation objective. Both commit the central bank to use all available tools to achieve its objectives and use forward guidance on interest rates and large-scale purchases of long-duration assets as the main tools to achieve these objectives. Although there are still some important distinctions in terms of how policy is conducted in the two countries, much of these differences at this point are due to differences in legal framework and the current starting point for economic activity and inflation, rather than reflecting fundamental differences in philosophy. For example, the BOJ's asset purchases are broader than the Fed's, extending to equity, exchange-traded funds, and real estate investment trusts. This option is not available to the Federal Reserve because the Federal Reserve Act sets tighter limits as to the type of assets that we can purchase. Similarly, current circumstances in the two countries are different with respect to deflationary expectations, still in the process of being dispelled in Japan. The Bank of Japan needs to push up inflation expectations, whereas in the United States, the current level of inflation expectation is consistent with our inflation target, so we just have to keep them where they are. Therefore, the Bank of Japan, relative to the respective sizes of the United States and Japan, has adopted a purchase program that's more aggressive than the US program. This is true whether measured either by the amount of duration being pulled out of the market or in terms of the amount of purchases as a share of total issuance. Now, as I mentioned earlier, there have been at least 6 major areas where there have been significant learning which has influenced the evolution of policy. So let me turn to those 6 lessons. The first lesson is the importance of managing expectations. Managing expectations is always central to monetary policy, but at the zero bound, this is even more critical than usual. There are 2 aspects of that. First, keeping inflation expectations anchored at a level consistent with the central bank's medium-term inflation objective, so that's 2% on the personal consumption expenditure deflator in our case, is vitally important. Once deflation expectations become well entrenched, it's very difficult to change them. And because inflation expectations are an important driver of actual inflation outcomes, deflation expectations can be self-fulfilling in driving actual deflation outcomes. Also, if inflation expectations were allowed to fall, this would raise the level of expected real interest rates, inflation-adjusted interest rates, and this would make monetary policy less accommodative. Conversely, a central bank doesn't want medium-term inflation expectations to climb above levels consistent with its inflation objective. If inflation expectations were to become unanchored to the upside, this could damage the central bank's credibility and result in higher risk premium for financial assets and tighter financial market conditions. Thus, a policy that maintains medium-term inflation expectations in line with our inflation objective is most consistent with our mandate. Second, with respect to expectations at the zero bound, the ability to provide credible forward guidance, both in terms of the future path of the policy rate and the future path of the balance sheet, those two things become the predominant vehicle by which the central bank's actions affect financial market conditions. If this expectations channel did not work, then it would be very difficult to provide additional monetary policy accommodation because short-term rates could not be reduced materially. In the United States, in recent months, we've communicated that short-term rates are likely to stay very low for a long time. Our balance sheet is likely to increase further in size and then stay large for a long time, and that we will not be overly hasty in tightening monetary policy once the recovery gets well established. By doing this, we're influencing expectations about the likely future path of short-term rates, which in turn influences the interest rate term premium. By utilizing the expectations channel in this way, we've been able to make monetary policy more accommodative and generate easier financial market conditions. The second important lesson is that good communication is essential. To manage expectations well, both credibility and good communications need to be followed. This means explaining clearly the policy framework, the relationship between use of the tools and the central bank's mandated objectives at the zero bound, and how the use of these tools will evolve as the outlook changes over time. In this regard, the central bank's credibility is critical. Only if the central bank does what it promises to do will expectations be solidly anchored. Now, of course, this doesn't mean mechanically following a set policy trajectory regardless of how the outlook changes. But it does mean that the stance of policy over time must evolve in ways that are consistent with the criteria that has been established in the guidance. It's important to communicate how policy will respond to changing economic circumstances over time. This is particularly important when the outlook changes because expectations about how policy will respond can be an important self-stabilizing element of monetary policy. In this regard, a framework that ties the use of the policy tools explicitly to economic outcomes has many advantages. Good public communication is also important. For example, the chairman's press conferences offer an opportunity to ground the policy actions in the stance in a framework that is explicit about how the central bank plans to achieve its mandated objectives. Third important lesson is that asset purchases are, in fact, a very effective tool of monetary policy. Credibility requires taking action in the present as well as providing guidance about the future. We are fortunate that we've learned that asset purchases can indeed be an effective tool to support growth, employment, and inflation expectations at the zero bound. Now, while I believe that managing expectations is crucial, I'm somewhat skeptical of the view that forward guidance on the policy rate alone is sufficient in these circumstances. This is particularly the case when the guidance extends out several years into the future. Promises about future actions may not be seen as fully credible given the potential for changes in the central bank's leadership and policy committee, and just the degree of uncertainty there is about how economic conditions will prevail that far out in the future. In recent years, we've developed considerable experience providing accommodations through changes in the size and the composition of the central bank's balance sheet. Taking interest rate risk and mortgage prepayment risk out of private hands has proven to be effective in easing financial conditions, increasing wealth, and lowering private sector borrowing costs. The impact of our purchases may be attenuated to some degree by deleveraging and ongoing adjustments in markets that we've seen, for example, in the real estate sector. But even in these cases, it's material, and it does build over time as those needed adjustments take place. Fourth lesson, the sum of policy is greater than its parts. The current stance of policy in terms of the policy rate, the balance sheet, expectations about the future stance, the degree of commitment of future policy, the clarity of communications, they all interact. Our tools are more powerful used in combination, and when their use is explicitly tied to outcomes that we seek to achieve. So I conclude the sum is much more powerful than the component parts. The fifth lesson, risk management, is particularly important at the zero bound. At the zero lower bound, once you're caught in deflation, it's very hard to get out. Thus, policymakers need to put considerable weight on this risk and conduct monetary policy with sufficient aggressiveness to ensure that they can avoid such an outcome. But it's also true that we have less experience with monetary policy tools used at the zero bound. As a result, there's greater uncertainty about the efficacy and costs of these tools. That pushes in the opposite direction. That tells you we need to be cautious. This means that risk management is essential. What's the cost of being wrong in either direction? Sometimes, as we see, a cautious incremental approach may not always be the right strategy. In the sixth lesson, there are definitely limits to monetary policy. At the zero bound in particular, monetary policy encounters additional constraints. These fall into three broad buckets. First, there are costs associated with the non-conventional tools. That means they can't simply be used without limit, though the appropriate limit will vary upon the outlook and the balance of risks. The most obvious example of this is our large-scale asset purchase program. As the balance sheet increases in size, the potential costs increase in terms of market functioning, the risk to financial stability, and the path of future remittances from the Federal Reserve to the U.S. Treasury. Second, there is a limit on how far the expectations channel can be exploited. As I discussed earlier, since the current FOMC cannot bind future FOMCs, and the economic outlook is highly uncertain, it isn't reasonable to expect that policies that affect expectations many years in the future will have a powerful impact today. I believe that the effectiveness of the expectations channel decays as the horizon, length of the horizon expands. Third, monetary policy is only one leg of the stool necessary to generate a vibrant and sustained economic expansion. In particular, as noted earlier, the health of the financial system is critical, for without it, the monetary policy transmission channels will be impaired, and monetary policy will be less effective in influencing the cost and the availability of credit. Similarly, it's critical that fiscal policy be set appropriately. This means that the short-term impulse needs to be properly calibrated to the current set of economic circumstances. In other words, not too much near-term restraint. And the long-term budget trajectory needs to be credible and consistent with fiscal sustainability. Finally, removing structural impediments that hinder growth and foster economic rebalancing are also important. In the case of the United States, this could include changes in immigration policy, infrastructure investments that remove bottlenecks, and job training programs that improve the quality of human capital. So what are the implications for the U.S. monetary policy regime? Well, undoubtedly, we will continue to learn as we seek to implement monetary policy most effectively. Let me give you a few examples of how my own thinking may evolve. In terms of our asset purchase program, I believe we should be prepared to adjust the total amount of purchases to that needed to deliver a substantial improvement in the labor market outlook in the context of price stability. In doing this, we might adjust the pace of purchases either up or down as the labor market outlook and the inflation outlook changes in a material way. For me, the base case forecast shouldn't be the sole consideration. We also have to look at how confident we are about that outcome actually occurring. Because the outlook is uncertain, I can't be sure today which way up or down the next change will be. But at some point, I expect to see sufficient evidence to make me more confident about the prospect for substantial improvement in the labor market outlook. At that time, in my view, it will be appropriate to reduce the pace at which we are adding accommodation through asset purchases. Over the coming months, how well the economy fights its way through the significant fiscal drag currently in force will be an important aspect of this judgment. We are also learning about how best to prepare for the eventual normalization of monetary policy. For example, we may need to update our thinking with respect to the so-called exit principles that we published in June 2011 in order to bring them up to date with developments since then and to ensure that they don't unnecessarily constrain our ability to conduct policy in the most effective way today. Those exit principles, just to review, stated that we would first stop reinvesting, then we would raise short-term interest rates, and finally sell agency mortgage-backed securities over a 3 to 5 year period. Those exit principles seem stale to me in several respects. In particular, how does one time the end of reinvestment given that we now have economic thresholds rather than date-based guidance that governs the timing of liftoff? Also, the thresholds are thresholds, not triggers. So it's hard to link the timing of the end of reinvestment to the unknown liftoff date for short-term interest rates. More broadly, it may be desirable also to update our thinking about the path and the composition of the balance sheet over time in light of our capacity to shape this path in a way that mitigates potential costs and risks. For example, the agency mortgage-backed securities portfolio is substantially larger today than it was in June of 2011 when the original exit principles were devised. To the extent that the committee wants to reduce the risk of disrupting market functioning during normalization, it could decide to indicate that it will avoid selling mortgage-backed securities during the early stages of the normalization process. Moreover, to the extent that the committee wants to mitigate the risk of a sharp increase in long-term rates, it could judge that it would prefer not to commit to agency MBS sales. Expectations about future MBS sales or actual sales have the potential to generate or amplify such an upward spike in long-term rates. If the committee believes that it would be costly in terms of credibility of the central bank to incur a period of no interest payment remittances to the Treasury, this is a notion I'm personally somewhat skeptical about. Avoiding agency MBS sales would also reduce this risk. Indeed, the FOMC might conclude that it was better on all three counts to allow agency MBS securities to run off passively over time. An important challenge for us will be also to think carefully about what combination of actions and communications will best ensure that when we do eventually judge that it's appropriate to begin to normalize policy, the initial tightening of financial market conditions will be commensurate with what we actually desire. There's a risk that market participants could overreact to any move in the process of normalization. Indeed, there's some risk that market participants could overreact even before the normalization process begins, when the pace of asset purchase is adjusted, but the level of accommodation is still increasing month by month. Not only could such responses threaten financial stability, but they also could make it harder to calibrate monetary policy appropriately to the evolving economic situation. We'll need to think long and hard about how best to develop policy in a way that enables us to respond flexibly to the changing economic outlook, but in a way that's not disruptive to the economy. Based on what we've learned to date at the Zero Bound, I think it's going to be important for us to anchor our communication around a core principle. The path of the policy rate and the size and composition of the balance sheet over time will be driven by our unbending commitment to our dual mandate objectives of maximum sustainable employment in the context of price stability. As you can see, there will be much more to learn as we go. I want to thank you today for your kind attention, and I think we'll take a few questions. Thank you.